And now today's featured speakers are Bentley faculty Dave Gulley and Jahangir Sultan. Dave is the chair of the Department of Economics and has been at Bentley since 1990. He specializes in macroeconomics, monetary economics, and financial markets. He has been co-advisor to Bentley's Fed Challenge teams since 2007 and teaches courses in macroeconomics and monetary economics at the undergraduate and graduate levels. He is also a proud alum of the University of Kentucky. Jay Sultan is the professor of finance and founding director of the Huey Center for Financial Services, the Trading Room at Bentley University. He teaches fixed income and international financial management at the undergraduate and graduate programs at Bentley. He has published over 35 articles, some in prestigious journals. He received the 1999 Bentley University Scholar of the Year Award. He's also actively connected with the local and international finance professionals. Also joining today's conversation, we're very fortunate to have one of our alums who works in this space, Guillermo Fernandez, class of 2013, a private banker and former Fed Challenge participant during his time at Bentley. And so he'll add some flavor to our conversation today. So without further ado, please join me in virtually welcoming Professors Dave Gulley and Jay Sultan and Guillermo Fernandez. Thank you.
Thank you, Emily, for that very kind introduction. Let me share my screen here. Okay. All right, so again, thank you, everybody. This is a very hot, hip, and trendy topic that's happening now as we speak. I'd also like to thank Guillermo, who's a former student of mine, for contacting me yesterday and offering to assist with us today. He's got maybe some on-the-ground perspective that might be very insightful. So our outline today, I'll show some pictures. I always like to show some visuals of what's happening. We'll talk about why maybe GameStop and other companies have been seeing high volatility in their share prices. We'll talk about, well, why GameStop in particular, as opposed to some other stock. The mechanics of what happened are also very interesting. There's a lot of behind the scenes stuff that have been related and have worked to drive prices up. And then we want to talk, well, how's it all going to end? And maybe it's, as we speak, ending, or maybe other things might happen. And then finally, we'll ask some questions about the larger significance. For example, is this part of a trend? Are there regulatory and legal issues arising, or are there other things? Or is this just a temporary blip that will pass in the night here? So some pictures. This is a 5-day shot of GameStop's share price. And as you can see over on the far left, it was nearly $500 a share. In fact, the intraday high last week reached $494 per share. And as you can see over here on the far right side, the last quote from about a half an hour ago was $64 a share. And even in the last few minutes I just checked, it's fallen down nearly to $60. And so today is not a very good day. As you can see, the last 4 days have been very poor days as well. So here's a zero, and whoops, I thought, oops, my apologies. I thought I had a longer term shot here. And so then also we have the trading volume. And what's interesting here is that if you go back, so I've got a picture here. I thought I had a longer term shot of the prices. I've got a longer term shot of the trading volume on GameStop. And as you can see on the far left, a year ago, trading volume compared to recent trading volume now was exceptionally low. So this was a fairly thinly traded stock that wasn't seeing very much action and was trading around $3 or $4 a share. As you can see over on the far right, trading volume has skyrocketed recently. And of course, a lot of the attention has been given to the Robinhood traders who have bought 1 or 2 or 5 or 10 shares at a time. They, however, cannot explain the trading volume that has been observed. So it isn't just the first point I want to make here, it isn't just the Robinhood traders that are participating here. These are some large trading houses that have to be involved to generate this kind of volume. The other thing that's interesting has been happening is, aside from the actual share price itself, options have also seen a lot of action. Options are financial assets that allow you to buy an underlying asset, like, for example, a share of stock. And so these options trade, and they trade on a number of factors, including what the current price is of the stock and what the expected price is and how volatile the stock is. And so, as you can see here, let me get my pen.
Dave,
Yes.
I'm sorry to interrupt you. Are
Sure.
you able to put it in presentation mode so that we can see the visuals a little bit larger on the screen?
Oh, I thought I was in presentation.
That's okay.
mode. Hold on here.
You're in your presentation mode, but
Oh, I'm in my presentation mode.
yes.
Okay.
That's much
Does
better.
that help? Okay.
Yes.
Okay, great.
Yes, we can see the smaller numbers well. Thank you.
Fabulous. Okay, good. All right. Whoops. So, all right. So can I get my pen operating here? Oh, I can't. Oh, well, never mind on that. And so if you look sort of in the middle here, where the column says last, these are the prices of the various options. And so, for example, there's an option that exists where it gives you the right to buy one share of GameStop at $71. And the price of that option is $35.71. And what that tells us is that there are still people out there who are willing to pay $35 for the right to buy GameStop at $71 a share, even though the current price is only about $63 a share. So what these options prices are telling us is that there are still some very, very optimistic people out there. All right, so in terms of thinking about what's been going on in GameStop and other similar companies, I think what's happened here is probably not just a single event, but really it's a confluence of events. So for example, as recently as 2019, trading organizations like E-Trade and Schwab and other places were charging maybe $5 per trade, which relative to what it used to be in the not far distant past is extremely low. But starting in 2019, they introduced commission-free trading. Now, there's other ways that they make money, but the commission cost went down to zero for the typical trader. So that reduces trading costs for the Reddit crowd that we'll talk about here in a minute, and that's pretty important. In addition, social media allows small traders like the Redditors to communicate with each other and to coordinate. In the not far distant past, that would have been very difficult, if not impossible. It's always been easy for the large traders to coordinate and communicate, but not so much the small traders. And so that was important. Then there's the pandemic that put a lot of people at home with some time on their hands. And so what did some people do? Well, they got involved in trading. And so you combine that with the introduction of companies like Robinhood, who have tried to angle their business model at small, high-frequency traders. Unhappiness with Wall Street, the unequal distribution of wealth, the perception that the fat cats, so to speak, on Wall Street are making out while the little person isn't doing very well. That has motivated people to sort of band together to some extent. And then finally, it always is the case, or most times the case, is you need sort of the right person at the right time. And this would be in the form of a gentleman named Keith Gill, who's actually local. He lives in Brockton, who has been instrumental at engaging the online Reddit community to line up behind mainly GameStop, but certainly also other companies as well. All right, so why GameStop in particular? Well, until recently, in fact, even now so, GameStop was a heavily shorted stock, meaning that we'll talk about the mechanics here in just a minute. This is a bet the share price will decline. And so then Keith Gill, who was a participant, an active participant in one of these online Reddit forums, sort of zeroed in on GameStop and was able to mobilize a lot of support for buying small blocks of shares. Now, to be sure here, as I showed you a minute ago with the trading volume graph, those small shareholders and those small buyers weren't sufficient to generate that trading volume. But along the way, folks called momentum buyers piled along. These are institutional and other traders who don't care so much about the underlying fundamentals of a company. They're more keen on whether they want to take the ride up the elevator or ride down the elevator, depending on which direction the shares are going. And then finally, what's interesting here is that of maybe the people who trade in GameStop, perhaps this might be a relatively known company. It's a very well-known gaming company. It's been around for a number of years now. And so it's possible that they zeroed in on this company simply because of their relative familiarity with it. And what I want to point out here is that GameStop is probably the most notable example, but AMC movie theaters, BlackBerry, And then maybe even they've moved over into the silver market, though they're not quite sure about that. And the action has not been as dramatic as it has been in GameStop. And so, as we saw in the chart earlier, is that, GameStop, a year ago was about a $4 stock, and now it's $63, and it was as recently last week a $494 stock. So has anything happened to GameStop, the company, to warrant that dramatic increase in its valuation from a company that was worth not even $1 billion to a company that was worth nearly $35 billion? And the general answer is, well, not very likely. But if you look back at the surge, it happened in a sort of a very Hemingway fashion, sort of gradually and then really all at once. And so I pulled a quote here from a recent article I found. And so, there's always these little catalysts here. So for example, in January, GameStop announced some new directors would be joining the board, and new directors, of course, might bring the company in a new direction. In addition, there were some companies like, for example, Senvest, some hedge funds that were taking long positions, and they were sort of betting on, well, will the company improve itself thanks to maybe the new directors, thanks to moving away from in-person buys in the brick and mortar onto online platform. So maybe they were looking here to make a few bucks. But even still, GameStop is a company that has seen steadily falling revenue over the last 6 or 7 years, and they've been closing a number of outlets. They had at one point 5,000 outlets, and that number is declining. But what's interesting here is that, as we'll see, a lot of the buyers don't seem to care too much about the underlying fundamentals of the company. And so in the short run, because of that, it's pretty easy for the share price to become unlinked to the underlying value of the company itself. That does happen very frequently. And so here, for example, is a visual. This is a very common. And so you have a going out of business sale. And the question is, well, is this a nearly $500 company worth $35 billion? And again, the short answer is no, it's probably not. So turning to the mechanics, how did all this happen? So a lot of folks, including some hedge funds, thought that GameStop was not a particularly solid company, and perhaps over some point would maybe file bankruptcy, or at least the share price would fall even more. And so short sellers took positions. And the way short selling works is they borrow shares and then sell them. Because in financial markets, the way you profit is you buy low and you sell high. Short selling, they reverse the sequence of it. They sell high, and if life is good and fair to them at least, they sell the shares high, buy them back later on when the price declines, and pocket the difference, just like somebody who buys low and sell high pockets the difference. So again, Melvin would be an example of a hedge fund that bet this or made this bet. It didn't work out so well for them. So what happened here is you had 3 related factors driving the upward pressure on GameStop stock. So as we mentioned already, the Reddit forum crowd, and I've got a few of the suitable for family posts from this forum to illustrate some of the interesting dynamics that are going on there. And so they put some upward pressure on it. And as I mentioned, probably some momentum traders also piled along in for the actions. Then the options market, there was a lot of action there. Some of the Reddit crowd, they were also, aside from buying underlying shares of the stock, they were buying options. And so what they will do is they'll buy these options, and these options come into existence from people who write or create the options for which the Reddit crowd could buy. And the difficulty is for those people who write the options is that it's possible that whoever buys the option might exercise it. In other words, they exercise it so they have the right to buy the shares from the original creator of the option. So to hedge that outcome, the creator of the option will buy the underlying shares. So that generates some upward pressure on the price of GameStop. Okay. And then finally, we get what's called a short squeeze. A short squeeze is a very interesting phenomenon. And the idea here is really pretty straightforward. Is our short sellers, remember, their hope is that the company doesn't do very well and the share price continues to fall. Well, sometimes what happens is they bet incorrectly. The share price rises. So what they've done is they've now sold low and bought high potentially. So they face a risk. Well, if the share price continues to go up, then they get in real trouble. If at some point the share price goes down, then they'll be okay. And so what happens is that some short sellers will simply back out and they'll give up. And in order to cover their position, they have to buy the shares back. Then they've lost money in doing so, but they've limited their losses. And so all these three factors were working together at one point to push GameStop shares to a very high level of value. And so what happened is you took a fairly small cap company and put a lot of buying pressure on it. You saw the volume data I had earlier, and then you get this gigantic price surge up to nearly $500 a share. And so then how does this end? Historically, there have been many instances of companies that have seen, or entire markets that have seen price movements that are unrelated, usually in the upward direction, to the underlying company. And what tends to happen is markets, again, over time are relatively efficient, meaning share prices reflect the value of the company, its earnings, the quality of their management, and all the other fundamental factors. And so there's pressures on the asset prices to move toward those fundamental or those right prices. And in order for this to not happen, the Reddit group, for example, they need to maintain cohesion and focus. In other words, not sell. The problem here is that works possibly against their interests. And so if you are a Redditor and you were lucky and bought GameStop at $10 a share, even $60 a share is a very nice profit. And so it's in the individual interest to sell out when the share price is high, but maybe not so much in the collective interest. And I pulled this little quote out from an article I saw interviewing a Reddit person who was trading in the market. And the idea here is, and this is a direct quote, it felt like I was part of something bigger. So they were not just trying to buy low and sell high, in other words, make a profit. They felt part of a community, in other words. The problem, of course, is that these individuals, individually and collectively, are taking on enormous risk. And so in the Reddit forum, they refer to people who hold on no matter what as diamond hands. And people who sell at the first sign of any problems, they refer to them as paper hands. And so they have their own little language here that describes different types of people and how they behave. And so then now we have a whole bunch of larger questions here. So one of the standard operating schemes that happen, as long as we've had financial markets, are what are called pump and dump schemes, meaning somebody buys shares of a company. Then what they do is they pump up the company. They advertise it, they market it, they tell their friends, they find a forum, in other words. In the old days, they would create newsletters, they would create blogs and things like this. Now people have social media accounts. They have accounts on the Reddit WallStreetBets forum. So they have all kinds of mechanisms to pump up interest in this stock. And then, of course, once the share price rises, they have a lot of incentive then to dump the stock and pocket the difference. So good for them. But this, this has some legal issues, but there are other things here too. As I said, are they doing this to generate profits for themselves, or is there a larger factor trying to drive this? An anti-big finance bent, for example. So, does this mark the rise of the individual investor? Well, over the last year, as the pandemic has taken hold and people have been home, individual buyers in equities markets and other financial markets as well have skyrocketed. Their percentage of individual buyers and sellers as trades has dramatically increased relative to the size of institutional buys and sells. Now, will this be will this trend continue, post-pandemic? That's hard to tell. But once people sort of get into the stock market, some of them tend to stay. And let me give you an example, is for all the negative press that Robinhood has endured in the last week or so, downloads of their app have continued to skyrocket. In fact, at several points, they've been the most downloaded app on the Apple Store and in other app stores here. So perhaps maybe Robinhood won't take such a beating, though we'll see. Will there be regulatory changes? So as we speak, the SEC is investigating various Redditors and also the institutions like Robinhood and the clearinghouses. Related to that is this, so if you look at the forum, the WallStreetBets forum, many of these folks are very small traders, 5 shares, 10 shares, 50 shares, something like this. Is it legal for them to band together? That's an open question. It's unclear because usually the securities laws are aimed at large financial institutions banding together and then acting as effectively one giant financial institutions. But what's interesting here is that Bill Galvin, here in Massachusetts, is asking Keith Gill, who's I mentioned is kind of one of the driving forces here. The problem for Mr. Gill is that while he was doing this, he was an employee of Mass Mutual, and he is a registered securities broker. And there are extremely clear laws and regulations that govern his behavior regarding investment-related activities. And so he perhaps might be in trouble. The individual Redditors who are listening to Mr. Gill, they probably won't have any difficulty. But Mr. Gill, unfortunately for him, he may be a different story. So then what happened in the last week and a half or so is that Robinhood did something very interesting. They restricted the ability of their customers to buy GameStop and some other companies. Sometimes they limited them to only 1 share, or several occasions couldn't buy any at all. And on the Reddit forums, there was a lot of talk about Robinhood, doing this to support the big traders, the big hedge funds who had, for example, short positions, like Melvin that we mentioned a few minutes ago. And so was Robinhood, sort of in cahoots with other large institutional investors? And from the way I see things, and be interesting to hear other opinions on this, is I don't think so. And the proof is not in what Robinhood so much has said. They've said they've done this for not nefarious reasons, but in what they've done. So for example, in the last just 10 days, they have raised nearly $3.5 billion from their venture capitalist owners. And also they've exercised a $500 million line of credit from their banks. Raising nearly $3.5 billion is not a cheap or simple or costless thing to do. And the only reason they did this, or would have done this, is because they needed the money. The reason they needed the money is because Robinhood and other institutions like them, they have to meet SEC capital requirements, they have to meet collateral requirements. And the idea here is that when money changes hands, you need collateral and you need capital to make sure that the money and the shares end up in the proper hands as a result of stock trading. And so as a specific example here, Robinhood, and this is a standard setup here, Robinhood works with outfits that are called clearinghouses. The clearinghouses make sure that the sellers get the money they're owed and the buyers get the shares of stock they're owed. And this is a very complicated web of companies, and they take risk because in situations where there's a lot of volatility in stocks and where there's margin trading, meaning people can borrow money to buy shares, is that those actions entail risk. That risk has to be insured with capital and with collateral. And so to be specific here, one of Robinhood's clearinghouses asked for $3 billion of collateral to make sure that all the trades could be properly settled to minimize risk to the clearinghouse. Now, Robinhood was able to negotiate them down to just under $1.5 billion. But the point here is this, is it's unlikely Robinhood was acting at the behest of, say, Melvin or other hedge funds who were in a short position, because they wouldn't have done the things we just mentioned had they not had to do that, because there are very high costs to doing, to raising funds like this. So just some quick screenshots here. AOC has taken an interest in this. She was on Twitch the other day talking about potentially investigating Robinhood for some of their actions. Here's the tweet. We now need to know more about their decision to block retail investors from purchasing stock, while hedge funds are freely able to trade the stock as they see fit. And so there's, could be some interesting hearings here. So here's one of the more, family appropriate posts I could find from WallStreetBets. And so there's a number of little, symbols here that are interesting. And so first you see, like this post if you're holding, and then you see the little diamond emoji in there. That's for diamond hands, people who hold on no matter what. Real squeezes yet to happen. Then you see one more little emoji. It looks like a tiny red, white, and blue rocket ship. And so that's a little emoji to the moon for hopefully the direction to which, you know, the price will rise. And then you see the little YOLO there, that's you only live once. Okay, and so what this person is doing is they're exhorting their fellow Redditors to hold the line. And so here's the thing about diamond hands. There are no sellers. Do not panic if you see the price drop. Hold the line. Upvote so people don't panic. And so this person, this was back when the share price was $296. That it's now, nearly $60. And this was just a few days ago. This person hasn't made out so well, unfortunately. Right. So here's another post. What Redditors often do is they post information off of their accounts, and it's difficult to verify these, of course. So this person had over 5 million, again, their claim over $5 million at risk here. And so perhaps that's true, perhaps it's not, because it's not very difficult to actually fake these kind of things, for their own purposes. In terms of the mentions here, this is from an outfit called ThinkNum, is they're able to scrape the Reddit forum and catalog mentions. And so you can see up there at the top, GameStop over this particular date, the 28th was by far, the most frequently noted company. But then there's AMC, Nokia, BlackBerry, and and a whole bunch of others there. So they're not alone, but they're getting the most attention. And then finally, as I mentioned a minute ago, I just pulled this out of today's Wall Street Journal. This is the downloads of trading apps. And you can see that Robinhood is up at the top. And so they've effectively gotten themselves a whole lot of publicity. And if that leads to more accounts, well, maybe good for them. And so that's it. That's the end of my presentation here. So let me stop my share. All right, there we go. So I guess over to Jay and over to Guillermo for comments, questions, pushback, disagreements, or anything they'd like.
Excellent presentation, Dave. I think I'm going to leave it to Emily as the master of ceremony to direct some questions, then we can have a conversation. How's that?
Yeah.
Sounds good. Guillermo, did you want to make any comments from your position on Dave's slides, or shall I get right to the questions?
I'll just make a quick comment. Dave, excellent presentation. You definitely got it all. And just for the general public, everything we're gonna talk here, it's not financial advice. So please don't take this as any, do your own research if you want to get into any trades. And I'm mandated to do this because of the laws that Dave was talking about. When you have a position where you get paid for financial advice, there are certain restrictions that you have to follow. And that's one of the ones that this guy, Gila, that was working for Mass Mutual, didn't follow. So I think that he's going to get into some trouble for it.
Great. Well, we have lots of questions. We'll get started with some of the questions. One of the main themes is around Robinhood, of course. So one question that was posed, and you can speak more broadly about Robinhood in your response. We'll start with you, Jay. Do you think Robinhood restricted buying GME, or the stock for GameStop, in order to help the hedge funds by artificially lowering the stock price?
Obviously, the answer is no, it did not do that. But everybody's related to everyone these days, okay? But indirectly, it is possible that they felt the pressure, not directly, but from someone to really control their own capital requirements. And don't forget that Robinhood makes money by order flow. Okay, more order they get, the more money they make. So and they also lend money to investors. Okay, through the margin trading. So Robinhood probably was working more in terms of protecting their own capital, own future. So directly, I don't think so, because if that's the case, then definitely folks from Robinhood would get in serious trouble. And the fact that they had received a call for $3 billion and negotiated to 1.4 billion at the end. It also tells me that perhaps Robinhood really did not see this coming. As an exchange, as a brokerage firm, they better be fully capitalized. Otherwise, what happened on the market regarding GME stock could have happened to other exchanges, other platforms, and they did not face this problem because they had adequate capital, but Robinhood was not. So that also leads me to question whether these two folks that started Robinhood, were they really prepared for long-term business model, or they were just getting into the hypes of fintech and starting a company. Suddenly the company became very, very popular, very profitable, and then something happened like that. Something like that happened. So it's very difficult. But I will say that no one called Robinhood say, listen, I'm a big hedge fund. I've got a huge hedge short positions. Stop trading. That probably did not happen.
I would agree. The other point to make, aside from, as Jay mentioned, and I mentioned in the presentation, is, Robinhood raised all this money that they would, that's not a trivial thing for them to do. And they wouldn't do this. They wouldn't bear that cost, maybe, just to make some hedge funds with a short position happy. The other thing you got to keep in mind is, as I had a little note somewhere in the presentation, is there are also hedge funds that either through some combination of genius or luck, or maybe both, happen to have long positions. For example, Senvest, I think I mentioned in the presentation. So there are hedge funds that had the other side, and they, of course, would have wanted Robinhood to keep trading. And so you've got hedge funds on both sides of this bet here. And so that they would listen, Robinhood, to just the hedge funds with a short position, I think strains a little bit of credibility. And then finally, again, the old saying is, actions speak louder than words. And so Robinhood said, gosh, we did it for these capital reasons. And then they go out and they raise nearly $3.5 billion of capital. So actions matter.
Yeah, one thing I want to mention here, I think Guillermo can also attest to that, is, this capital requirements is a very short-term thing, just to make sure that they have the money to back up all the long positions. If you say that we're going to buy 100 shares, you've got the whole day to come up with that money. The money was going to come out of your bank and then go to the Robinhood, then Robinhood would, make sure that that money is available to the exchange. But they were just inundated with the sheer volume of long positions. Their buy side was so much that they were not able to do the netting. Netting is, when you have a huge positions of buy orders, they have to be matched with the huge positions of sell orders. Well, for Robinhood, lots of buys, not enough sells. So essentially, they were stuck with I don't know how many millions or billions of dollars they needed today. Make sure, because the NSCC, the exchange, the DTCC, or the clearing houses, they got panicked. They say, okay, all these buy orders coming from Robinhood, for example, are you really going to buy these shares? If you do, show me the money. That's it. Guillermo, I think you can attest to that, right?
Yeah, absolutely. Yeah, I think that it's very important to understand and explain to the retail investor that whenever someone buys a stock, that trade doesn't happen immediately. So you don't really own the stock for the next 2 days. There's a settlement period where it used to be pre-computers that actual paper would change hands, and it would take about 5 days, 3 to 5 days. Now, thanks to computers, it's been reduced to 2 days. But it's still, there is a 2-day period where someone has to put that money on behalf of you to cover the responsibility of your intention to whether buy or sell a stock. That someone, it's whoever you broker with. So in this case, out of the sudden, Robinhood and other brokerage firms had to come up with all this money for an abnormal order flow. So why didn't we see this across the board? Well, we have to keep in mind that Robinhood although very popular and very successful, it's still a startup. So they are still advancing on their capital requirements. They're still developing their market, while, for example, Charles Schwab or an E-Trade or someone a little bigger might not have those. Okay, they might have better order flow and more diversification on it. And a different thing that I also wanted to mention is that, remember, there is no such thing as a free trade. There is no such thing as a free lunch. It is trading by definition. In this case, it's not free for anyone. It's just that you are not being charged for it, but the company makes money by selling those orders and that order flow in the market to hedge funds, so they can front run you by doing micro millisecond trades, and that's called high frequency trading. So what happened here is that there is a lot of talk especially in the subreddit, that Citadel, who is one of the biggest purchasers of that information from Robinhood, might have pushed these intentions. And just like David was saying, it doesn't really make sense for several reasons. One of them, we know that the capital requirements exist and they are reallocated every single day. So a brokerage firm every morning would, first thing you do, you get in and you see, well, my capital requirement for the day is going to be X amount. And that amount, it's actually very obscure. There is not a formula that says this is how you calculate it. There is a portion of it that is called market risk, and it's determined by the clearinghouse. So that's why initially they were asking for $3 billion from Robinhood, and they were able to say, hey, we cannot do this. We cannot raise capital in this amount in less than 24 hours. We need some time. Let's negotiate to 1 point something, which actually ended up being $700 million that they covered for that day. And that's sort of like how it played.
So Emily, can I respond to one question? Sorry to take away.
Of course.
I mean, there was a question on, thank you. There was a question on how to properly do short squeeze in the market. Very interesting question. My first question to that question is, why do you want to do short squeeze? Okay, let's go back. I'm going to put on my professor's hat. The price of any company's stock should be equal to the fundamental value of that stock. End of the story. There are times that price is going to deviate from the fundamentals because of so many things, sentiment, behavioral finance, all sorts of things, can happen. But in the long run, the price should reflect the fundamental value of the stock. So I did a quick calculation, and I also looked at a bunch of reports. Is that right now, if you look at the price of right now on my interactive broker terminal, the price is about let's see, $66. Guess what? Given that right now the market cap is 5 billion and there are 69 million shares, so if you divide one by the other, the price is $71. Okay, I personally think, it's my opinion, not an investment advice or anything like that, GME or the GameStop does not have the fundamentals to even support a $71 stock share price. It does not. One of the analysts in the trading room did a valuation analysis on GME last year, and she found out the value was $10. Okay, based on it. So instead of trying to do short squeeze in the market, think about doing a lot of research on the market. Think about the fundamentals, the cash flow, the revenues. What are the free cash flows, and then you will be an educated investor because companies that are strong with fundamentals, I don't think you're going to see this much of volatility. I don't think so. So trying to do short squeeze in the market, it's a tough thing to do. And finally, one more comment is that, in the short run, market is anything but efficient. Okay, but in the long run, I think things work out. Okay, things work out, and there's a significant, substantial difference between trading and investing. Okay. So someone did a research the other day is that probably 1% of the day traders are profitable. The rest, they probably will be selling apples from their BMWs, okay? This is just a joke, okay?
Hey, that's absolutely true. And that's why in order for you to be a day trader, there is a regulatory minimum. You cannot be a pattern day trader unless you have a minimum of $25,000 on an account, okay? Mm-hmm. The reason why that law came about in the 80s was to prevent regular people who didn't have the capital to do it from basically betting on the market. Because day trading, at the end of the day, there is fundamentals, there are all these things, but regular retail investors that get on it are really, for the most part, betting on it and not coming out successfully from it. So most people that do day trading and a retail investor do lose money.
Yeah, so if I could add a couple things here, this is a really interesting discussion. And so, sort of following up on Jay and Guillermo there is, yeah, nearly all day traders don't make out very well. And, so you hear, the newspapers, the people who participate in the WallStreetBets forum who've made, 100 grand, a couple hundred grand, even more. So they've made out very well. So good for them. But I can guarantee you, for every one person like that, there's dozens of others who bought high and is going to end up selling low or never selling, and they'll never make their money back. And so somewhere out there is some poor person bought at the intraday high of $494 a share. That was the highest intraday price last week. They're never going to realize that money back, unfortunately. And so those people, the worst possible, even worse than that, is not just buying it at $494, is suppose they bought it on margin for $494, meaning what you can do is you can borrow money from the broker, Robinhood, put up your own money, match it, what you borrowed from Robinhood, and then go buy shares. And so you've bought shares with your money and Robinhood's money. Shares go up, that's great, because you're leveraging Robinhood's funds to make more money on your money than what you put up. So good for you. The problem, of course, is instead of going up, share prices can go down like GameStop have. And so if that person who bought at $494 bought on margin, they've got a big problem, because they not only have lost all of their money, they've lost a big chunk of Robinhood's money. And Robinhood, of course, is going to come after that. And so there are a bunch of people out there who have had margin calls and haven't been able to come up with the money, and they're in serious trouble. And there's more than a few of those people out there, unfortunately.
David, I'm sorry to interject, but that you're saying, it's actually a perfect explanation of why the restriction on trade had to happen. Because some of this money that they had to put up, like some of these $3 billion, were capitals that they had lent out to traders, and they potentially would have to margin call on them. So I think that one of the things that's going to come out of all this, GameStop and meme stocks situation, it's going to be that the capital requirements for marginable stocks, it's going to change. Like after stocks hit certain volatility threshold, you will have to have 100% capital. You cannot borrow money on them. And we saw that actually for myself in the platform that I use, that is not Robinhood, I couldn't margin certain stocks on the day, and I wasn't trading GameStop. Like some other stocks that also got affected from this volatility play, they changed the margin requirements to 100%, not to have to incur into these problems.
All right, excellent. That's a really good point. Another thing, and this is sort of related to it, is I saw in a number of the submitted questions about short selling. And so short selling, of course, what that does is that reverses the sequence of the buy low, sell high maneuver that usually people, when they take a long position, make a profit. And so short sellers, of course, as we said, are hoping the share price falls. And so one of the common questions, well, why should we allow short selling? How does that benefit everybody? Because it only could cause prices to go down or be more volatile. And that's certainly true. But here's the counter to this. GameStop is, at least right now, who knows, things might turn around for them, but they're a pretty mediocre company, and they should have a relatively low market valuation. And short selling helps companies be correctly valued, meaning some companies do get overbid. They get more action and their share prices maybe become higher than what lots of folks think they actually should be worth. And so so hedge funds will show up and say, gosh, we think they're overpriced, and they'll short it. Like we said, they'll borrow the stock and they'll sell it. And the share price goes down, good for them. What's happening there is that, yes, that is working to push share prices down, but critically, from a market functioning point of view, what it's doing is it's bringing those short sellers, it's bringing their information to bear into the financial markets. And so their trading actions reflect in their information. There's other hedge funds or any others who are long holders, they have a long position in GameStop. They're thinking, gosh, GameStop is going to be a better company thanks to the new board members and other things. And so we're betting that they're going up. When they make their buys, their information is finding its way into the marketplace, and that affects share prices. When the short sellers sell, their information is likewise finding its way into the share price. And so there's that tension between buyers who think the share price will go up and sellers who think the share price will go down. But the idea is that information from both sides, both views, needs to flow into the financial markets so that over time, like Jay said, is that the share prices go where they're supposed to go where the company is actually worth. And if short selling is, for example, restricted or in the extreme case forbidden, that would limit that information flow. Again, because the idea being is that lousy companies should have a low valuation, right? Having high share prices or high valuation is not necessarily always a good thing. It would lead to a misallocation of financial capital. Financial capital should flow to good companies and should flow away from bad companies. But if short selling were restricted or eliminated, that flow of capital could be restricted. And for financial market functioning, that's not a very good thing.
David, and that information flow happened correctly and perfectly for almost 2 years, because something that, the average article that you read about is not realizing is that this game thing didn't start 2 months ago. This goes back to 2019. Okay, there was the whole GameStop situation started on Reddit by an user called Deep Value in 2019. This person made a $50,000 bet that he would buy these call options for January 2021. Okay, so he basically was on this long position for almost 2 years. And from there, shortly after, Michael Burry, the same guy that is very famous for the movie The Big Short, the one that realized that the financial meltdown in the 2008 was going to happen, this guy goes on and says, hey, I just bought a 3% position on GameStop because he did some fundamental analysis and came to realize that 90% of all the stores that they had, which is like 5,300 stores, were cash flow positive. So his take was the market is not being efficient at realizing there is some value here. So that debate between the long holders and the short sellers happened all the way until November of last year, and it was efficient. There wasn't this blow up. What really caused the meltdown was that Seth Cohen, the founder from Chewy, who sold Chewy to Petco for $3 billion, and famously, instead of looking for a good bank and a private banker to the diversification strategy, he went out and said, I don't believe in this. I'm putting half my money in Apple, half my money in Wells Fargo. And he's come out pretty well from it. And out of a sudden, this guy comes up and says, I put 10% of my money in GameStop, writes a letter to the board and says, you guys are not doing it right. I think that you guys should be looking at playing with being a technology company rather than a retail company. And GameStop responds by saying, you're absolutely correct. I'm giving you one board seat and your other two associates board seats as well. And that's what blew it all. Like, people saw these as the opportunity to revive GameStop and really just took off.
You know, I agree. I think that's absolutely a very interesting perspective from the GameStop point of view. You know, the fundamental fact is that we should not, frankly speaking, we really should not do anything other than to go after who are colluding, who are manipulating, okay? The financial market is working fine to a certain extent. Large companies have advantage because they've got capital, they've got clients, they've got, you know, volume, and so on and so forth. Small investors, they just have to do a lot of research and then can do a very good job in selecting the stocks that will retain the value. But the fundamental problem is that this person, Keith Gill, okay, being at Mass Mutual, I think Mass Mutual may be in trouble right now because they really did not control their employee. And this guy passed all the Series 3, Series 7, Series whatever series you can talk about, all the exams. And so this person actually has a fiduciary obligation. If you have a fiduciary obligation, you cannot simply say, I think the price is going to go to $70. You cannot say that if you don't have the numbers to back it up. And the person, Keith, was fleshing out his trading profit, just like David showed, okay? Those are very, very scary things. So everyone is now suffering from a disease. People who bought this stock, they're all suffering from a disease now in recent days. It's called FOMO, FOMO, fear of missing out, okay? So, you know, they think that, you know what, price went up to $400, I'm gonna buy it because I think the price is going to go to $700, for example. That's not gonna happen because at the end, the price has to drop. What goeth up must cometh down. That's what I believe. Back to you, Emily.
Well, I know Guillermo has to leave us right away at 1, but there have been some questions. I don't know, Guillermo, if you want to respond to this question in the chat about Flash Boys, given that you were showing us before. The question is, does this panel think that Flash Boys, or in other words, first look, is still allowed and being arbitrage under the approval of the exchanges?
Well, so it still happens, yes, and that's actually how Robinhood and some other companies make their money. Okay, they are able to sell the information of the order flow. So when you go ahead and grab your cell phone or your computer and submit an order, there is a delay. So you're really not buying instantly on the market. You're buying 3, 4, 5 seconds after. The time in between, it's a time where Robinhood sells your order to someone like Citadel, and they can, through computers, buy and sell in the exchange. So basically they buy cheaper and they sell to you at the price that you want it. So that's still happening. And unfortunately, the regulation, if you look into actual SEC and markets regulation, there are very, very few mentions of the term millisecond. Okay, there is mentions of minutes, there are mentions of hours, but millisecond, it's not really mentioned. And it wasn't mentioned at all, actually, until 2011 when they started getting into this. So for the moment, we don't have the proper regulation to not have these things happen. That's as much as I can comment on it.
Yeah. Well, I did want to, before you have to leave us, I did want to thank you for jumping on our panel today. We were so blessed to have you join us.
No, this is phenomenal. Honestly, when I saw that you guys were doing this, I figured that I knew it was going to be interesting. Dave, it's always phenomenal explaining, and I think that he, you know, in the very good fashion of the professor that I took classes with and I admire, he did a great job in letting everyone know here why this is going on. And eventually I'm just gonna drop the bomb and leave and say, Dave, markets are not rational. And I wanna leave you two to discuss that. I'll step out, and I look forward to talking to all of you soon.
Thank you, Guillermo.
Thank you.
We'll stay on and
Thank you. Thank you.
answer a couple more questions before we leave all of you, because we do have so many questions. There were a lot of questions about the group think, and the question you showed, Dave, in your slides, the quote about being part of something bigger. What do you both think about collusion as it pertains? I mean, WallStreetBets is still up, so
Yes.
What are we likely to see as far as implications on the future of these Reddit-oriented investment decisions? Someone else in the questions is calling them lemmings. Are there plausible systemic risks resulting from these lemmings?
Well, that's a good question. To the scale that they've so far worked, the answer is no. In terms of large scale systemic risks, have there been risks to particular companies? Absolutely, right? Both Robinhood and, for example, GameStop and maybe a few others. But at least right now, the scale on which they're operating, it'd be pretty difficult for me to imagine that there would be systemic problems here. But over time, as we noticed that Robinhood app downloads are increasing, there are other similar apps. More apps could be developed, and so institution or individual investors, they could continue to increase as a fraction of trading. And there's upsides and there's downsides there. The upside is, well, maybe more people are getting involved in the stock market, and it's a way over time, to grow and to build wealth. But as Jay mentioned, if you're going in and you don't know really exactly what you're doing, there's a pretty good chance you might make out pretty poorly, in the sense that you're not making well-informed decisions. You're doing more trading than you should. People who trade a lot, other things equal, tend to have lower returns than people who don't trade. And so, it's good that they're getting in, but that they're getting in brings with it risk. And so over time, maybe they learn by doing. They learn from their mistakes, and clearly, there are going to be some people, in the Reddit forum who I hope will learn from their errors. Though, if you listen to some of the quotes and some of their motivations, they're not, trying to do that. They just want to be part of a community, and maybe punch back at the big boys and the big girls of Wall Street, for example. And so if you have people who are motivated to buy and sell with those goals in mind, that could impact market efficiency. Maybe not just on even particular stocks, but maybe on a broader level. Now, granted, I do think that over time, prices, both at the micro level and the macro level, go where they're supposed to go. Not just stock prices, but bond prices and foreign exchange prices and options and all the rest of them. But for periods of time, sometimes long periods of time, prices can become, unanchored from or unrelated to, what the underlying value is. And so the point I'm making here is that individual traders are not, for no reason, called noise traders very frequently, meaning they don't necessarily trade on the underlying fundamentals. They're, it's based on a friend's tip, or now, of course, a tip that we read or they've read, in the WallStreetBets forum.
Yes, I agree. I think I really feel bad for people who bought at the high and now they're looking at the price is right now is $63.75 right now. Okay, sorry about that. The issue is, would you pay $400 for a company with a profit margin of negative 4.2%? I'm reading off my charts here. Return on equity was negative 56%. Earnings before interest, taxes, and depreciation was negative 129 million. Net income was negative 217 million. So there was a reason why, hopefully there was a reason why people were shorting this stock. Okay, shorting does some stuff to the company. They, try to improve. In the end, if they cannot, they go bankrupt. That's it. If the company is in a really bad situation, but you really should not be jumping into the bandwagon, say, let's manipulate, okay, with that, because as retail traders or noise traders, we really don't have the expertise, the capital, the resources to make very sustained bets. We don't have deep pockets like these big companies do. I think that's why the most important thing is to understand is the price consistent with the fundamentals. That's it. And then you make your decision. And joining a club and to have a vendetta against someone is not a good reason for you to become an investor.
The irony here is that to the extent that individual investors become increasingly important in trading, additional volume and so forth, that could cause, and if they are, to the extent that they behave like noise traders, they don't trade on, trying to buy good companies and sell bad companies, for example, is you're going to see additional volatility in asset prices. So stock prices are going to fluctuate up and down more. And the irony is that's going to give the Wall Street investors, the people with the deep pockets, the ability to do the research, the people with the capital, they will make money off of that one way or the other. They'll make it off of the order flow that Jay mentioned. They'll make it off the margin trading, or they'll make it off, they'll be able to, more efficiently price companies, and they'll be able to buy more, buy low and sell high, trading. And so that would be, to me, the irony of it. And, because the idea is that a lot of these small Reddit traders, they just want to, fight back against Wall Street. Well, there's entirely possible that they might act to put more money in Wall Street's pocket.
Yeah, you took the words right out of my mouth. That's exactly what will happen, as more noise trading gets on the way, and then we're simply making it easier for the other side of the equation to make more money. Okay, they thrive on the noise trading, and remember, they don't have to. The prices don't have to move a lot. They will just make money in pennies. Okay, and with this algorithmic trading and statistical arbitrage and things like that, the individual retail trader, I don't think we have very good idea exactly how the market is operating, when they're driven by all these machines, okay? So it's very difficult to fight those machines. So that's why, invest for the long term. That's it. That's my advice.
Well, thank you both. We've had so many questions still unanswered, but I know that I would not be remiss to say that either Jay or Dave or both would be happy to have you reach out and continue the conversation, continue the debate. Please do feel free to reach out to them directly. I also want to thank you both for jumping on this panel so quickly when I posed it to you both. So thank you very much. Do either one of you want to make a final comment?
Yeah, I would like to make one final comment. I know that the SEC, the Federal Reserve, and the Treasury, they're all talking to each other, and Maxine Waters is also having a session where they're going to bring in a lot of people. I hope that they monitor the market, but I think a knee-jerk reaction to this event and imposing more restrictions or more regulatory measures would really have a very negative impact on the market. And for all practical purpose, the market is doing well. It's supposed to be doing what it's supposed to do. Buyers and sellers express their opinions, and that's it. When there is manipulation, things are going to get will turn bad for others. So yeah, if they're trying to control manipulation, I'm all for it. But otherwise, putting more restrictions on trading behaviors might be counterproductive.
Right. Also, I would agree with that in general, because market regulations and rules and laws, are designed to, prevent manipulation, prevent collusion, and protect, Joe and Jane average investor, from the big boys and big girls, so to speak. It's difficult, however, to protect Joe and Jane average from themselves with any form of regulation, because to the extent that you do that, as Jay said, impacts how well financial markets function and how well they allocate capital and how well they allocate risk. So yes, there are going to be hearings and so forth, and so it's going to be hot and trendy for a while, but they should be very careful about imposing regulations that make it more difficult for average investors, for example, to participate, because at least so far there hasn't really been any evidence of market makers, Robinhood, the clearinghouses, the hedge funds doing anything that was even remotely legal, or remotely illegal. Some hedge funds made out very well. Other hedge funds like Melvin, for example, have gotten their clocks cleaned, and that's okay. They're big boys and girls, and those are the risks that they take. And so yay for them if they make money, and too bad for them if they lose it. They know the risks very well, when they signed up to play in this game.
Well, thank you both so much again for your time today. Maybe there will be a part 2 if things continue to be as hectic and crazy as they have been, but we really appreciate both of your time. Thank you again, and everybody have a nice afternoon.
Yeah. Okay.
Thank you, Emily.
Thank you, everybody. Bye now.